I
I got
appreciate you sharing. Thank you.
this was awesome. I got to pop in here because we are ready for Lex. The Lex team is on with us, so we are going to continue chatting about real estate, specifically fractionalized real estate. We're going to talk about the market. So to anybody that can stay on, please do. But round of applause for Balcony Down, everything that they've been doing. To see the team come on here every single week, chat with us, give us insights, knowledge towards the market is really really helpful to have. John, I'll kind of hand it to you for a second if there's any last words you want to say, and then I think we're going to keep it rolling.
Yeah, if anybody out here bought deeds, if you were part of the recent zeitgeist here, the people who kind of jumped into this community and jumped into our Discord, I want to thank you guys so much for doing that. Our community is growing in leaps and bounds, and it's really exciting for us. As a founder, the coolest thing about Web3 is you do these things, you get immediate feedback, and the immediate feedback that we're getting is demonstrated in these deed sales. People are buying these deeds. They're excited to get BAC. They're excited to buy these real estate assets that we're going to release as RE NFTs. They're excited to get those tax advantages that are inherent to this asset class that we're able to flow through, which you can't get in publicly traded securities typically. They're excited to come to these events and to meet us, to share alpha. They've been bringing us deals all over the world. People brought us deals from Costa Rica and Spain and Portugal and places, frankly, that I've been looking at doing real estate developments for years, for decades. And it's cool to see people that are thinking along the same lines and to finally have a place where we can get together and talk about these deals that's never really existed before. And I just want to thank everybody who's decided to become a part of this community and to share their talents, and share their intellect, and share their passion and their energy. It means a lot to us, and we'd like to thank you, Gav, too, for having us on these spaces and let us talk to people about this and have people interrogate this business model. Hawk had some real cutting questions there, and I appreciate those because that's what you want in any community. You want people who are like, hey, I'm calling bullshit. How is this actually going to work? We appreciate that. You should do that. We encourage that, and we love that we can have those conversations here.
Love it, John. Appreciate you being on and answering all of those. Shout out also Mike, Alex, Dan, the rest of the team. Huge part of the community. If you have any questions, you can DM any of them. That's Cryptodamus, Mr. Assets, Balcony, Mike, or John. And of course, make sure that you are grabbing those deeds. Link pinned up top. All right. We have another great mind in the real estate world here with us. We have Alex on the Lex account. Alex, let's get into it. What's new with Lex?
Well, thanks for having me back. What's new with Lex? Well, we are now in with the SEC with our next offering going in. So that'll be our fourth one on the platform is coming shortly, and we're in the hopefully the closing days of filling up our third offering. We've expanded the Lex team. We've got two of our latest and greatest hires hosting an event this evening in our office, which I would normally be running, but unfortunately I'm stuck at home with COVID. But we've got Matt Johnson on our team, who we're very grateful to have, a new head of equity capital markets, who's got a long career at Barclays and Morgan Stanley, running equity capital markets desks over there. And Kareem, our new managing director on the real estate investment banking team, who we're bringing over from Ventures, who's just a long time real estate investment banker, really great relationship guy. We're stoked to have him on board. Aside from that, yeah, we're growing. We're bringing more stuff on, trying to expand the audience, expand the investor base, expand the offerings, day in, day out, grinding.
Awesome. Alex,
Yeah.
appreciate you being. Oh, sorry, you cut out for a second there, so I wasn't sure. You
No,
back
go
on?
ahead. Yeah, I'm back on. Go ahead.
Okay, cool. So real estate's been pretty crazy lately, and we just had a really interesting conversation for the last hour. A lot of different pieces, obviously moving. We talked about the fractionalization. We talked about potential bubble markets. We talked about different pieces. That is something I want to get into.
Yeah.
But first, John, I'll just kind of bring it in if there's anything you want to say based off what Alex first started saying here, and then we can roll from there.
Yeah, I mean, so first of all, what's up, Alex? Guy I respect in the space. Love what you're doing as well. Birds of a feather. Sorry that you have COVID. That sucks, but we all have to get it about 100 times, it seems, before this thing is gone. So you're just part of that process, I guess. I'd love to hear that you've expanded your team. You're always tapping some really good talent. What's the focus with these new hires? Is the idea to create more underwriting capacity so that you can look at more deals, to source more deals? What's the idea there?
Yeah, so twofold, and I'll quickly address and we'll drop. So this is actually, I'm very lucky. I've somehow managed to avoid getting COVID until now, so I made it almost 2.5 years. But like you said, you have to get it eventually. Two new hires. So Kareem is actually an old partner of our current head of real estate investment banking, John Todd. They used to be partners at a private equity firm together. The two of them used to run. I think Kareem has actually been there or stayed on for a while after. Um, he's really focused on expanding our funnel, right? He is deeply ingrained in the institutional real estate community. Really knows how to plug into all of the sort of major players, and his focus is going to be on bringing more and higher quality product to the platform and expanding the inflow of stuff. Um, Matt's job is going to be focused on the distribution side, right? And that the faster we sell, the faster we can sell products, the more products we can bring on, right? Also, the faster we sell, the more partners we have, the more firepower we have in our investor base, the better equipped we are to bring on better assets, and the better equipped we are to go to people and say that we have confidence we can execute an offering. So Matt's job is to shore up the other side of the table and help shore up the institutional capital side to go and come in and back these offerings and help really get the machine rolling. And has a long career of doing similar stuff at some of the larger financial institutions out there.
Yeah, I mean, I think that the unspoken truth that just needs to be discussed, I think, is the reality is when you're creating markets for real estate, institutions play an incredibly important role in terms of how they help you navigate the SEC regulations for your total number of investors, how you can capitalize these things. And I think that they can work in harmony with retail investors. And, that's sort of part of our message is it's not an us versus them. I think that rubric is sort of like a right versus left. It's sort of like one of these like simple binaries. But you have to have, I think, strong institutional relationships to really capitalize these assets and create liquidity in them. And so that hire and that mindset that you espouse, I think, is critical to success. So I support and applaud that.
Yeah, and I think one to your point, I think it's all about working together, and it's also the more firepower you have, the more cool stuff you can go conquer, right? It's like if you want to go shop at Costco, imagine Costco had a sale on like Wagyu beef, but you have to buy 100 pounds of it, right? Alex, am not going to eat 100 pounds of Wagyu beef before it goes bad. My freezer's not big enough, right? If I want to go and get Wagyu beef for, $10 a pound on sale at Costco, I got to bring in enough friends. And the reality is that we have deals on the table that we can go look at that are that, holy crap, I can get Wagyu beef for $10 a pound, but we don't have enough retail there to go and throw $100 million into a deal yet, right? I think it will be there. I think as this platform grows and this concept grows, we're going to get there. But for now, the people that have $100 million to throw around, those are the institutions, right? And the fact that we can put retail on the same playing field as institutions, I think, is really the mission of Lex, and that's what we're doing here, right? Everyone's coming in on the same basis. Everyone has the same opportunities. It's all through Reg A, so everything is all disclosed in public. There's no, secret sauce hiding around in the background. And retail has access to institutional quality deals, and institutions get access to institutional quality deals that Lex is able to go source, underwrite, and structure. So it's really a win-win for everyone, and we're really scale that platform up with that.
Yeah, the critical piece there is that the basis is the same. That's the critical that's the critical component to this. That's what makes it fair, and that's what makes it not a contentious retail versus institutional relationship whatsoever. You're not going to get chip bullied by Citadel inside of one of these offerings. You guys are on even playing field, and that is also, I think, that is the new ethos for business, and I think that's part of why you guys are going to be successful.
100%. And I think it's also just worth noting to your point there, these shares are non-voting, right? So just because you own fewer of them doesn't mean you have fewer rights than the guy next to you. There is no way that Citadel can come in and say, actually, hey, I vote to do this thing that's disadvantageous to somebody else. And it's funny because I've read 2 or 3 stories in the last week of cryptos doing stuff like this, right? Where, and it's mostly gone against the institutions, but the idea that you can say, hey, you thought you invested on this basis, but we, the shareholders, voted, and actually, just kidding, we don't like you. Now you're going to lose money because we voted on it. Um, that's not a way to run an investment, right? My investment risk when I invest in something should be based on the actual asset or the company or whatever it is I'm investing in, not on the pool of people I'm invested with wanting to screw me. And so we're completely insulated from that. I've been really appalled to see that in the crypto space recently.
Yeah, it's disgusting. It's the tyranny of democracy when it's used against the purpose, and it's prevalent, and it's easily solved for if you just remove the incentives and remove the structures that allow people to get run over in that way. And there's lots of different ways to do that in Web3. The way that you guys are doing it and your approach, I think, is very good and it's very sober. And so I would like to see how this plays out long term. I think it's going to be really good. I really do. I think that the institutions need retail, and I think retail needs institutions. And I think if you structure it in a way where you don't cause them to be at loggerheads, it can be incredibly productive.
I think we're there, right? And they say build it and they will come. So we've now built it. So everyone, please come aboard and come check it out.
Very cool. And for those that are unfamiliar with what we're talking about, so this is the world of fractionalized real estate, and that's becoming something more popular. So I think a lot of people have heard of it. And there's a few players in the game, but one of my favorite ones, and the ones that we've been doing spaces with consistently, has been the Lex team. We've had on their CEO, we've had on Tyler Schwartz just before I was working with them beforehand. Alex, of course, who is a major component of their team now. And of course, we're hearing that they're hiring too. So for those that want to check it out, I read this amazing stat the other day, and I actually had to like Google it because it was just mind blowing. But if you go ahead, you could look it up. Real estate investing has created this is listen, like obviously don't believe everything we don't Google. This is from thecollegeinvestor.com, but it's also like all over when you look for this, and it's on CNBC, it's on realestateinvesting.com, like Quora, like everything. And it states real estate investing has created 90% of the world's millionaires. Interesting topic, right? It has contributed in some way to the development of 90% of the globe's millionaires. Real estate is one of the most reliable wealth building structures, as well as an essential element of a well-diversified portfolio. So that is from a couple different websites that's coming together with. But the overall concept is here, a lot of smart people have for generations been taking money, putting that money into the stock market, making money off the stock market, and then taking those profits and investing them into real estate to provide cash flow, to provide other methods of security. However, a lot of that real estate and a lot of those deals is very difficult to access, right? You, and many times, have to be an accredited investor. You have to have maybe a minimum, let's say 10,000 or something level capital. And of course, you have to understand how to do due diligence into these areas, right? You have to be able to look into these different buildings, and as you scale up, the harder it gets, right? To have an understanding of how many tenants are in there, how often are they paying rent, who's defaulting, are there any structural problems with this building that could affect it? Maybe we'll have to do construction in the near future. What's it for repairs, who's the management, all different pieces that go into it. So what Lex has done is they've really come in with a very super neat, simple platform that really does a lot of this homework for you. They go in, they look for different, deals in the area, and they just go ahead and do these deep dive bets with a team that is trained on doing those type of things, right? So Alex's background in real estate, probably been doing it since I was like born. I know John has. And so many more people on the Lex team. And John is on balcony down, so just to clarify, I was just making that reference because they're both up here. But yeah, this is basically a revolutionary opportunity where now you can come in with as little as $250, and you can buy a share of real estate that's been vetted, and not just vetted, all the due diligence is summed up and provided to you in one platform. So I pinned the link up top if anyone wants to see this. Lex does this awesome deal every week where they offer to anyone that wants to start out, you haven't started a real estate journey yet, $50 to start out with, right? And that's already 20% of your first purchase on their platform. So if you haven't clicked it already, there's a link. It is pinned up top in our space. It's the last post that I put out. It literally gives you $50 towards your first purchase on the Lex platform right after you fund your account. Again, very easy access, and you can go ahead and do your due diligence. I'm not telling you to just go buy something because it's on there, but I'm telling you the easiest way to understand all the due diligence that you need is through this platform. So go ahead and give it a shot, take a look. You can claim that $50 now, and you don't have to fund your account yet. And whenever you do fund, you'll get it. But even just to make an account takes about 1 minute. So you're on the space anyways, may as well check it out. It's in the top of the space. So Alex, if there's anything I left off of that, I'll throw it back to you. But I just thought that stat was like mind-blowing to me about that 90% number.
Totally. And no, Gav, I really appreciate you coming out there with a pitch for Lex. A few things I want to add into that, right? So for starters, one of the big advantages of Lex, right, is you're owning this not only on a small basis of, you have with the ability to have a small basis, right, of a $250 investment, but it's a liquidity enabling instrument, right? This sits in your brokerage account. It can trade like a stock, right? But unlike a REIT that you could otherwise buy in the stock market, this gives you all of the tax benefits of owning direct real estate, right? From an economic standpoint, it's as if you own the whole building, just a smaller portion of it, right? Which is super unique amongst all the other potential ways to go invest in real estate out there. I also think it's worth differentiating just from some of my experiences on these spaces in the past, right? So real estate, I think a lot of people think about real estate as okay, you buy a house, then you buy another house, you can rent it out. Right, and that is sort of the most traditional way that I think people have a real estate investing ladder. Nothing wrong with that, right? That's definitely a viable way to build wealth. But multifamily real estate and single family rental real estate is only sort of one small part of the broader institutional world, and a lot of the issue that Lex is trying to go solve here in accessibility to the market is for those other kinds of asset classes that people really have no access and no exposure to, right? The ability for an ordinary person, even a very wealthy person, to actually buy into an office building, into a hotel, into a very large apartment building, the kind of thing you'd see in a big city like New York or in Seattle. Those can be quite difficult to scale up to, and Lex is basically letting people steer around that decades-long growth path of you need to buy your 1 unit, then your 2 unit, and your 4 unit, and you can come in right away and you can invest in a 45 unit apartment building out in Seattle. That's an ultra luxury, ultra sustainable, passive house building in the heart of one of the hottest multifamily markets in the country, right? So you can skip all those steps in the middle of having to roll your way up and come in right away and invest at a higher level of institutional grade asset than you'd otherwise be able to go see on that tax advantaged basis.
Can we dive into the tax advantage and just how
Sure.
prominent that is?
Yeah. So if you were to buy a stake in a REIT, right, which we can talk about why I don't love REITs separately, but if you were to buy a stake in a REIT, right, every year a REIT is required to distribute a certain percentage of all of its income in distributions and dividends, right? When you get that dividend income, that's treated like ordinary income, right? It's as if you got paid, salary, right? You're getting taxed fully on that, right? And the REIT's just paying you a line item. Here's your distribution. Here's your income. There's your tax. When you have an investment with Lex, right? You don't get a 1099, right? You get what's called a K1 tax form, right? It's a partnership tax form as if you are an owner of the real estate, because you are an owner of the real estate, right? You are a partial owner. And what that lets you do is it lets you get all of the tax benefits of actually owning real estate. So things like operational expense deductions, interest expense deductions. The big ones are, depreciation expense is a huge tax benefit that doesn't exist in REITs that you get by investing in Lex. In the event of a ground lease, there's substantial benefits to tax benefits to ground leases. You benefit hugely from the difference between cash and GAAP accounting, which it sounds really silly and a little bit like technical, but it's worth everyone here understanding, right? Because it can have an enormous impact on your bottom line. And so, as a great example of that, our second IPO had a 100-year ground lease on it that, when straight lined over 100 years, as is required by GAAP and the SEC, shows it like about $1 million a year expense. In actuality, it's sub $400,000 a year of expense at the time of filing, right? So that delta of $600,000-$700,000 is money that to the IRS looks like a loss, but on a cash basis is your gain that you get to go take home, right? It's basically, I don't quote me on this, I'm not a tax advisor, but it's like having exempt money from taxes, right? And that's a huge benefit to your actual net bottom line that you're taking home. And again, it'll differ based on everyone's tax situation, and everyone has their own personal situation on how they pay capital gains and their state tax and whatever else. But it's massively advantageous over just getting a REIT distribution.
Perfect. Appreciate that information there.
Yeah.
Hey, also, just to the audience, if anybody does have questions throughout this, we'll be running for about 30 more minutes with Alex. We are happy to bring you up and take questions. David, what's going on?
What's up, guys? Hey, I got a
How's it
quick
going?
question. One, this is kind of for John and for Lex. A frustration for me investing in all these different spaces in the past had been, I guess, the learning curve of actually interacting with. I mean, I don't know what you call it in this case, like a share or whatever else of the property, right? And then also, like, what does it look like once you own it? I mean, is it on a third party platform or is it on your platform? How do you actually interact with it?
Yeah. So this can be in your own brokerage account if you'd like it to be. Right. Our securities are capable of being put into normal brokerage accounts. So it can sit next to your Apple shares and your Microsoft shares, and you own it like a stock. We also are our own brokerage platform, right? So we have native functionality where you can buy it on our platform and trade it through our platform, and it can live forever on our platform as well if you'd like it to. That's usually the easiest way. There's no sort of transferring from one brokerage to another. But either way works. And yeah, you own it just like how you own a stock, right? So it's going to sit in your account. If you ever decide you want to sell it and wake up one day and you want to get rid of it, you can put it out and someone can go buy it off you. There's no liquidity restriction. There's no minimum holding period. There's none of that, right? There's an active marketplace that we've created. Lex actually built our own exchange from scratch in partnership with NASDAQ. So we're one of the few SEC registered alternative trading systems out there that actually enables you to trade this just like how you would trade a stock. And yeah, you get regular updates on this. The filings are twice per year. So every one part of the year they put out unaudited financials. Then every year, just like a public company, you get an annual report with audited financials that comes out. And in your portfolio like a stock till you want to sell it like a stock, except it's real estate and you get tax benefits.
That's awesome. Hey, John. John Blitzky's a stud, everyone. I just wanted to also add that in. Sorry.
Love this guy. David, you're great, man. So for us, we have a deal that we're working to build our ATS similar to Lexus, which is frankly a little bit disappointing because I would love to see actually more centralization in the space. I know that's like anathema in the Web3 world, but there's a benefit to having centralized exchanges. We're building one that works with our RENFT and allows people to use our chain so that it feeds directly into our ATS to create that liquidity for Web3 natives. But you can also transact on our exchange with fiat. So it's similar to Lexus. Lexus is obviously linked directly into the NASDAQ as well. So it's different in that regard. But we have actually exceedingly similar worldviews and approaches to the space, just a slightly different path.
Sweet. Thanks for the question there, David. Appreciate you coming up.
Gang.
Love it. Hey, Hawk, moving out of the Web3 side of things, do you have any thoughts on fractionalized real estate and kind of that trajectory and how that's been bringing more people into the space? No worries. Might be busy for a second. Okay. All right. I got another question then, Alex. I've been posting about it, and I'm just so curious with the real estate market. We're flying here, right? And we talked about this a little bit in the last one, but right now, S&P 500 is down over 20% on the year. Bitcoin's down like 55%. What's the next shoe to drop? You go and look at the housing market, and in my mind, when I heard the housing crash, right, and all that, I went and looked at median home sales for the U.S. and I was expecting to see a big drop. They dropped from like 250 to like 210, and then made that back up within really just a couple of years. It looks like from the median home sale, and then that just continued to move upwards. Now, obviously, that's median sold, right? So it doesn't include the ones that maybe were foreclosed upon, never resold. So you might have to educate me a little bit there. But if you look at that chart, it is just flying, and it's up basically 100K per house since COVID started to over 400 something thousand now. right?
Yep.
So how sustainable is this? What numbers should we really be paying attention to gain a good grasp of the real estate market? And is there even maybe more value to Lex because someone could not feel comfortable, because someone could want to buy real estate now, not feel comfortable buying a house because they won't have the liquidity to sell it, buy Lex real estate, and then if they get uncomfortable, be able to easier liquidate.
Yeah, so a couple things here, right? So firstly, I don't think that you can really categorize, it's very hard to categorize real estate as a singular thing, right? I much prefer to think of it as asset classes, right? So residential real estate as its own thing, right? To your point, that's where everyone's attention is, and you hear all this stuff about a crash. Obviously, home prices are up substantially, rent prices are up to record highs now. There's a huge crunch on that part of it, right? Where that comes from really is supply and demand, right? In that you have a demographic shift of more and more people coming of age where they want to go buy homes, coming of age where they want to go leave cities and go raise a family, right? And you don't have the supply of homes there to go meet that. Um, that's where most of this comes from, right? And the combination of that, and this is on the demand side, is willingness to pay, right? You can't have demand if you can't afford to go buy, right? And part of what's driven this insane demand is having very low rates, which has made it very affordable to buy, right? Having a 2% rate difference might be the equivalent of having, say, a 20% difference in price, right? So when rates fall from 2 to 0, prices can go up 20%, your payment's the same, your affordability is the same, right? What's happening now is we're seeing rates go up, right? Rates going up makes everything less affordable. That will necessitate some relief on prices for residential real estate. People will be less able to afford more expensive houses, right? Which means both there will be less people trying to go buy because there will be less people who are able to afford stuff, and people who are made to go sell, who are incentivized to go sell, will be forced to sell for less because there will be less ability in the market to go and pay, because rates will be higher. Payments will be the same, but the actual rate of interest will be higher, making the actual purchase price be forced down lower. So you have that dynamic going on broadly in the residential market, and that again it comes from really that lack of supply. That lack of supply in residential really stems from 2008, right? In 2008, you had obviously a massive housing crash, and it was bad enough where a large portion of builders retired, stopped operating. There was just a huge shift in the industry of how new houses got built post the 2008 crisis, and it never really recovered. There's been a continuing deficit of home building over the last decade plus. The supply chain issues of the last year or so have massively exacerbated that issue, right? Where it's even harder and harder now to build a new house. Um, but the shortage was there either way, and now it's really coming to a head because it's more expensive than ever to build, and that demographic shift of people coming of age and having that big bulge of people in their sort of late 20s to early 30s looking to go buy their first house, and there not being enough houses is going to keep driving demand and keep driving prices up. It's going to prevent a huge crash in prices. I don't think you're going to see huge appreciation because that rate tamper is going to push it down. But the bottom is not going to fall out, in my view, like it did in 2008. I want to change direction, though, because real estate, like I said, is not just about multifamily. Um, I think you are going to see different dynamics in different kinds of asset classes, right? So, office, for example, is a really hot topic. I actually, I got a prompt about an hour ago to go and write a piece for a publication, hopefully for tomorrow, if I can write it in time, the future of the office market, right? The office market's, in a little bit of trouble, different than the residential market. Residential, people are always going to need a place to go live. The office market, people don't need a place to go work all the time anymore. COVID has ushered in, the work from home era, right? And there's a big outstanding question across the board of what does it mean for all these different companies, for the whole office industry, that more and more jobs are going to be hybrid, remote work from home, whatnot. What happens to office space? And my view is that um, it depends what kind of offices there are. The industry is broadly going to hurt, right? Class B and C office is going to fall out. It's going to fall off. People are not going to commute into a big city to go and work in, a walk-up office with cockroaches, right? That just ain't happening anymore. I've done it. Lots of people have done it, but we don't live in that world anymore, right? People are going to commute into the big city to go work in, one Vanderbilt with, the outdoor pool and the roof deck and the shiny glass lobby and all the community and indoor plants, all that stuff. That will attract people, right? And there will be certain companies, who can afford that space, who can afford to pay people enough to come into the office. And there'll be companies who can't afford that space who will say, you know what, I can pay someone 20% less if they work from home from Idaho. So, you know what, screw it. Let them work from home from Idaho, and I won't rent an office in New York. Um, and that is going to massively shift the office market going forwards. And I do think the office market is in a really tough spot generally. Not all office. I think that certain offices, like I said, are exempt from that. But by and large, you've got a lot of people who have sort of been, trying to go and hold it together, refinance, have high asking rents, try to put short-term leases in place, try to sort of bridge the gap until work from home is done. And I think that, the tide is sort of coming out, and some of those guys are going to get screwed in the short term. Um, I also, while I'm just sort of up here talking markets, I want to talk about industrial too, because I think that's something that gets overlooked a lot. And as an investment, especially from people entering the space, is not something people typically see, right? And industrial is as unsexy as it sounds in some ways, right? In terms of physical appearance, you're talking about a bunch of warehouses, you know, ugly old buildings, tin roofs in some cases, right? At the same time, that's where all of your online shopping goes. That's where your contractors building your house go and pick up their bricks and their concrete and their girders, right? That's where things get distributed out of. That's where the food, gets sorted out. It's an incredibly important part of our national infrastructure, and the need for it is growing. There's also a massive lack of supply. And so you can have these incredibly ugly looking buildings really have great return profiles. And it's funny because Blackstone and some of these larger institutional investors have been all over this for the last few years. I was actually involved early on in my career, and the largest ever European real estate deal was an industrial deal that I got to be a small part of. But those large institutions, they have to focus on big things, right? They can't do smaller kinds of transactions. They're the effort versus the not worth it for them. What Lex has done, we've been able to fill that gap and come into smaller kinds of assets that have the same kind of demand profiles, the same kind of return profiles, sometimes even better return profiles because there's less competition for the deal because there aren't enough players in the market. But we can bring in the investors to those sorts of deals, give those opportunities for people to go invest and invest in an asset class that has really strong macro backing.
Yeah, I
Okay.
think what's often not discussed is the geopolitical dividend that industrial is getting from the breaking of these supply chains, which is I really think instigating meaningful onshoring of a lot of industry, which is
Yeah.
another user of that same asset class. I think it's going to do really well. And then with the office, to your point, here in New York City, we've got about 500 million square feet of commercial office space. About 100 million square feet of that is what I would describe as at risk. And that chaos is also a ladder. There's going to be opportunities there. Some of those buildings can be repositioned and will be repositioned. And the benefit of platforms like Lex and what I'm doing as well at Balcony is you can select for the assets that will outperform inside of those sub asset classes versus just getting sort of an ETF, buying into a portfolio and it's kind of pot luck. It's like, well, you got this really great deal, but we also have this class B or C property in our portfolio, and that's structurally obsolete now. And you can select against that with the kind of tools that you're discussing at Lex.
100%. And back to both that point and my earlier point about why I don't like REITs. I think about a REIT as kind of like an ETF, right, or an index, right? If you want to buy equity residential, you're buying, some 300 apartment buildings in almost 30 different markets, right? That is very different than betting on an apartment building, right? You're saying I'm not betting on a building, I'm betting on an asset class. I'm saying that apartments are going to do well, and maybe they will, right? But in today's world where rates are going up, the economy is at risk, I think it's there's a lot more risk to trying to bet and be long on a macro play. It's much easier in my mind to be long on a micro play where you can say, okay, apartments might get hit, but man, this building that's got a shuttle going to the Microsoft campus right nearby, that's 10 steps away from Amazon, right? That's targeted towards like tech bros who are going to work at Amazon and Microsoft. As long as Amazon and Microsoft are hiring, I feel like that building's probably a lot safer than, the average stereotypical building in a 400 building portfolio.
Love it. I want to pop in here. I see we have a hand up from Abbas. One of the questions I'm going to ask afterwards, and I want to get Abbas to chat in here, and if Hawk wants to add anything else, that'd be great too, is, for anybody that is on the Lex platform, you can kind of follow along with my question. My question is, if you haven't yet, you can go up top and just click into the pinned tweet. It's linked up top. It's also linked in my bio. If you can't find it, it's the one that says claim $50 in real estate. So that's a really easy way to go ahead and check out the Lex platform, see what's going on there. But I did go ahead and I purchased a share of the Seattle property, and I kind of want to like get a deeper insight into like what does that mean that I am going to own a share. But before we dive into that in a second, and one more time again to anybody who has it, you can click in. It takes like a minute to make an account. You're going to be in this space for like 20 more minutes. So take the minute. You can claim your $50 at any point. Get started on that real estate journey. One of the best asset classes out there to be at least having a bit of exposure to. And if you're looking at it going, well, I think real estate's in a bubble, I don't want to get exposure right now, minimum size purchase here is $250. You don't have to break the bank. We're not asking you to buy a $10,000 property, just asking you to look at a really, really great asset class that tons of people do have exposure to. All right, Abbas, I saw your hand up. What's up?
Well, I love the conversation that have been going, especially in the last, like all of it, but the 15 minutes, the last 15 minutes was really important to look at in terms of the what is next with the work from home, and how multiple companies is actually taking this approach, and how that is actually going to affect the commercial real estate in a specific. But this is really important to look at it from another angle as well, especially with the having people probably reallocated from the state that they are in. Let's say from New York to other state that can afford, like, and save more money, that it's actually in this specific time with the inflation, they needed it. So it's might actually have that implication on the residential as well. You know what I mean? Because if you have the ability to work from anywhere in the US and you don't have to be in a really expensive city or a really expensive state, you can shift to another state, which is might affect the states that they have a high kind of labors that works from the used to work in the offices, and now they have the option to keep the paycheck, but to save on the rent or the mortgage or actually the taxes and everything related to it. So this is another side of that actually might affect the residential.
Yeah, no, it's true, and to some extent it has. What's also worth considering, right, is that cities are a lot more than just a place people live to go to work, right? I think that's one of the things that people have overlooked, and was overlooked in the first realm of macro analysis a year ago to exactly that point, right? Everyone sort of thought what you just said of, if people don't have to work in New York, why would anyone live in New York? I mean, New York rents have got to go down, right? And then exactly the opposite happened. More people wanted to live in New York, even when they weren't working here. I actually have a friend in New York who his company is based in San Francisco, and they hired him and asked him to move to San Francisco, and he said, "I don't want to leave New York. Let me work remote from here," right? And that's because New York's a fun city. There's Broadway, there's the clubs, there's bars, there's concerts, there's everything you could ever want is here, right? And people want to move to New York just to be here. So you now have people who, and it's not just my friend, there's a large trend of people who don't even have jobs in New York that are moving to New York because it's such a great city. On the opposite side, you are seeing some cities where that is more true. San Francisco has actually seen rents go up. Rents have gone up everywhere, but they've gone up much more slowly there than they have elsewhere, because they've had a crime problem, they've had living quality problems, And people have said, you know what, I'd rather go live somewhere else. I have friends who left San Fran. They spent the last 6 months working in Montana and Alaska because they said, well, cost of living's lower, and why not? By the way, Montana real estate is up dramatically. I think it's one of the hottest markets in the country right now for residential outside Missoula from exactly that trend. It's a bunch of San Fran people who've said, I don't need to be in San Fran. I'd rather work in Montana. And they've doubled the cost of real estate in Missoula. Um, so you're right that you do have those dislocated markets now, but I don't think it's necessarily uniform to just say, okay, cities are dead, cities are going to be hurt. You have to look at it on a much more case by case basis and say, what is the driver for this city versus that city? And that's going to be what drives prices.
Yeah, cities are systems, and they have network effects, and offices are a part of that system, but they are not the system. People who live in New York City tend to work in New York City, but that doesn't mean that if they could work anywhere, that they would choose to not live in New York City. And again, it goes down to block by block, asset by asset, and really understanding the capital asset and building your investment thesis into the individual asset. And that's my gospel. I know that's Lex's gospel. And it's hugely important to not take that sweeping macro view of the world and really kind of hone in on an asset level and understand what is this particular property going to do in this particular marketplace.
Really good stuff there, Abbas. Any other points you want to say on that? I kind of want to bring in Chad too.
Thank you for the answer. And it's kind of like important to look at it. Like you have the data, obviously. Like I don't in a way, but it's just like it wasn't kind of like assumption and reading. How is the so I live in Michigan, and what happens? Like Ford gave the option to 6,000 of their employees engineering to work from home. And that's like and they keep building offices, and it's kind of like look at it from a way probably it's previously like contracted offices, they have something to do with it, but on the way from here, when I take like one of the roads, which is all commercials, it's all been like empty for the longest time, and having like for lease sign on front of them, and now it's all full. So it's kind of, and it's expensive area to rent an
So
office in it.
yeah, no, there's another interesting trend at play there that's actually also worth talking about, right? Which is Office is much more binary than our Office is much more than the binary of are you in the office or not, right? One of the other really big factors that COVID has shifted is how much office space do you actually need, right? So, do you have 100% of people in the office now? In the best case scenario, no, right? Your percentage of attendance is going to be down from what it was almost no matter who you are, right? However, if you want to rewind 30 years ago, right, or 25 years ago, an office would have, 250 or 300 square feet per employee, right? You have a cubicle, you have a kitchenette area, you might have a lounge, you'd have some other stuff going on, right? You have other things in the office, and every person got more space, right? Over the last couple decades, that's changed a lot, right? We've seen open floor plans, we've seen this whole communal style seating, smaller and smaller desks. It used to be if you were the big boss, you had a 6 foot desk, and if you weren't, you had a 5 foot desk. In the last few years, we've seen 3.5 and 4 foot desks come into play, right, to cram more workers into a smaller space. That doesn't fly anymore, right? So even if you have the same number of workers, you're going to have a substantially larger footprint for that same number of workers because workers are demanding more space, right? No one in COVID world, no one's going to sit 2 feet away from their next person. They want to be 4 feet away, and that doubles your footprint. And that again causes people to expand and take more space when needed. And it's funny, at Lex, we came in, we took new office space in the Empire State Building a few months ago, and the first thing we did, like day one, was we ripped out like an entire section of desks and put in a lounge. Right, the office before it was high density, everyone just compressed in, and we said, you know what? No, we're not going to fill them all. We don't want to fill them all like that. We want people to actually want to come in the office. We added 2 couches. We added a table in the middle. We made it a recreational area, and it's paid huge dividends. It's actually right now in our space, using that area, we're hosting a networking event, right? That wouldn't have been possible without it, right? Because we've changed how the space gets used, and we've made it less efficient by a person-by-person basis, but it's actually more efficient on an economic basis for the company, and companies are realizing that and adjusting their office footprints accordingly.
Is that the space in the back left, Alex?
It is, yeah. Yep, that couch area. You've been in our office, Gav. Yeah,
Yeah,
those blue couches.
pretty comfy.
Yeah, no, it's great, and that was all high density seating before we came in there.
No, sorry, Alex, I cut you off there.
No, amazing, Lex. Let me tell you what, great answers, and thank you so much. This was so helpful in a way, like, while you're talking, I'm just like, damn, boy, Lex, you nailed it, buddy.
Alex does kill
Well,
it, as always.
thank you. I appreciate it.
Is this Drew behind the account?
Nah, not at the moment. No, this is Alex Epstein.
Oh, okay.
Yeah, Drew. For everyone else, Drew is our co-founder and co-CEO, who I think used to do these more frequently. He's actually at a conference right.
He's in
on a plane right
NYC
now.
now.
Well, he sits in NYC. He was in Dallas for a conference, and actually, I'm trying to look at the calendar and think about where he is. He's either on a speaking panel or on his way to the airport, getting on the plane after a speaking panel.
Yeah. All right, we got. Yeah, Hawk.
No, I was just gonna say I love what you guys are doing.
There we go. Sign of
Thank
approval.
you.
He's a hard man to please. Don't get that easy.
I appreciate it. Thank you.
Love it. All right, about 10 minutes left here. Also, real quick, shout out Tay Zonda for chilling with us for the last 2 hours in this space. Chocolate Rain Man, if anybody's not familiar. I think I watched that video like 15 years ago.
Wait, that's the actual guy. Holy shit!
Yeah.
Man. I watched that video on repeat like hundreds of times years ago. Oh my god, I'm honored to be in the same space with you right now, man. Thank you.
It's especially because I'm like a YouTube baby. All right, Chad, what's going on, man? Would love to hear if you have any thoughts on the conversation.
Hey.
Anything you want to throw in here?
Yeah, how are you, sir? So I think like I probably have the least, I think, really amount of info to probably share on real estate. But I think there's a couple things actually. I think realistically that I could probably share that might be interesting to some people. I think where I'm definitely focused is definitely crypto. I think 100%. I don't really have much interest in really real estate, and I don't know when I'll really buy a property. I personally have no interest in really real estate at all. And I think it's just a personal preference. And I think there's nothing against real estate. It's just I just personally don't like it. But there's obviously a lot of benefits to it. And I think what Lex is doing and have talked to obviously the founders of Lex, and I think what they're doing is amazing. And they obviously have incredible investors behind them. So now to something that I think is really interesting, I guess, for myself and what I've seen really traveling kind of over the past 6 to 7 months. Have been basically going from Airbnb to Airbnb, basically usually like a month at a time. And so what I think has been really interesting, and maybe one or more of the speakers up here have done this, is I guess something that's a little bit newer now that's called rent arbitrage. And essentially what people are doing and what I've seen is there's a lot of people like myself that have been traveling because we can work remotely, and my firm is entirely remote. And so there's a lot of people like myself that are just going around the country, maybe seeing where they want to settle down and using, facilitating that kind of living through Airbnb. And so there's people that, and arguably in a lot of places, and have had to kind of skirt some stuff sometimes. And I think Gav, even you, when in Miami, had to kind of skirt the local regulations. But a lot of different apartment places don't let you really do Airbnb. But what people are doing are they're signing leases, right? They're signing, 1 year lease, 2 year lease, whatever it is. And then they're putting up that same place that they just rented in their own name on Airbnb and renting it out, usually with a monthly preference, right? So people that are staying there for at least 30 days, and then usually adding on, $500 to $1,000 onto that so that people on Airbnb can rent it. And then, they're making basically whatever's in between there, right? So they have to pay obviously internet and internet and utilities, etc. And so I think that's incredibly interesting that people are doing that. I met actually when I was in Austin, the person I rented from, talked to him for a little bit. He has like 4 or 5 different rentals that he has in his name doing that. And there's been a few times where they've caught him, the rental offices caught him and they've asked him to move out ASAP and made him pay a fee, but they're still making money. And then also, I think just lastly on this is, I guess, become such a problem, this rental arbitrage and people really trying to do this. I guess such a problem in places like Scottsdale, Arizona, where I just checked as well. I think that there's actually so much supply and so many people trying to do this in Scottsdale that the current price for an Airbnb at a monthly rate is actually cheaper than something you could probably get for a lease in Scottsdale, which is not exactly like a cheap, obviously maybe in relativity to somewhere like in California, it's cheap. But in Arizona, it's one of the more well-known and more expensive zip codes, and you can actually get just a cheaper place for a month, because there is so much supply and so many people trying to do this. So I don't know. I don't know too much about real estate, but these are some of the things that I've seen over the past like 6 to 7 months really traveling, and I'm looking forward to settling down probably somewhere soon. But I think just rental arbitrage in general and this supply surge that's going on in Scottsdale with basically the it being so cheap now that you can get it for cheaper than a lease is interesting to me. So I think that's something to look out for as well as more and more people go remote and nomadic and try and travel a bunch of different places can really start to see maybe cheaper rates on longer term stays.
Yeah, so I want to respond to that. First off, I hear you on not being interested in real estate. What I would say is that you should always invest with your head and not your heart, right? I've definitely worked on projects outside of real estate that I've had absolutely zero, if not negative, interest in. But at the end of the day, I try to be a rational investor and say, you know what? Dollars are dollars. If there's money to be made, I want to go make it. I think there is money to be made in real estate. My sort of unsolicited and somewhat self-promoting advice, you should go check it out because I think there is opportunity, even if it's not your personal taste.
I would agree, but I think you would also agree that time is money, and I think that if you can make more money spending your time elsewhere, totally. I think you should also try and do that too.
If you can make more, if you can make more money elsewhere, then that's 100%. That's part of heart, head versus heart. But you shouldn't also at the same time you can't ignore opportunity because it looks weird. I've looked at some weird stuff where I've said this is silly, and it's been quite profitable. So just asking you to be open-minded there. In terms of the rent arbitrage thing, yeah, look, it's funny because my landlord actually has taken advantage of that, right? They're an institutional landlord. I rent from Equity Residential. And in my building, you can sign up for a 1-month lease or a 2-month lease or a 3 or 4 or 5 or 6, right? You can do furnished or unfurnished. My landlord has figured out, you know what? I think the 1-month rate for my apartment is just about quadruple, a little bit less than quadruple what it cost me to have an annual lease, right? And the landlord has said, you know what? For 4 times the money, fuck it, I'm in, right? And that looks comparable to a luxury alternative option for someone who's going to stay for a month in an Airbnb, right? So the landlords have gotten wise to this, at least the larger ones like Equity have, and I suspect that's why they don't like people doing it because you're just taking their money, right? Why would they let you do it when it's their property and they could do the same thing? It is interesting that Airbnbs are now cheaper in some cases than the actual leases. Look, I think Airbnb is a really great concept. It totally disrupted the hotel market. It has really negatively disrupted the housing market, right? And the housing market has long been impacted by sort of non-resident units, right? I grew up in London, despite this awful accent that I have, right? In London, in central London, almost half of the residential units are empty, right? Because core London real estate, more than any other market in the world, is basically just a safe haven asset for the rest of the world's, capital, right? If you have weird Russian money, weird Saudi money, weird whatever other money, right, and you're worried that someone's gonna wake up and take it out of your bank account or try to, steal it from you, you just buy London real estate and then you let it sit there forever, right? And you have a huge problem because the actual, people who do live there get priced out because there just isn't enough availability, right? And the same is true in New York to a lesser extent, right? But Airbnb is sort of like the democratized way of creating that problem, where you have units that are either sitting empty or are not being maximally utilized because they're being reserved.
Incoming phone call.
Did
My
you get?
assumption here.
Sorry, guys.
Nah,
I had a call come in. I think it may have muted me. But you have these units being held for economics that may or may not work out, right? In the hope that people are sort of speculating that they can get a better return on Airbnb, and when they speculate wrong, like you've highlighted out in Arizona, you've totally fucked the market in that case, right? Because now there's less supply, which is driving the real lease prices to be up, and you have all these reserved units that were bought for the wrong purpose without really having a fit place in the market, having to be liquidated at sub market prices because the market wasn't there. I think it's really disruptive. I think they're going to have to regulate some of that away. The market clearly has failed in that area, but it is an interesting trend to note.
Appreciate the back and forth there. Hey, Alex, do you have a hard stop at 6:30? I know we had chatted.
I don't. I was going to. My hard stop at 6:30 was for an event that I can't go to because I have COVID. So I'm home free for a while.
Hey, Alex,
Sorry
do
to
you
hear
have a personal Twitter account, or do you mostly utilize the Lex account?
I mostly utilize the Lex account. I have a personal Twitter that has probably like 2 followers and I never use. So yeah, you can hit me up on here and I'll respond.
Okay, so we'll do about maybe 5 more minutes on here, just to see if there's any other specific topics. The one topic that I wanted to know, Alex, is I recently purchased, made my intent to purchase a share of IPO of the Seattle building. What does that get me? I buy $250 of what? What do I own? Can it appreciate in value? Can it depreciate? How often do I get paid out from it? I'm just curious.
Yeah. So I forgot the exact number of shares that we issued in that offering, but you own, some percentage, right? 0.1%, we'll call it, right, of that building in Seattle, right? And you own that on the same basis as the primary, general partner owner, right? So there's no one above you taking fees or promotes or any of that other stuff. You own a direct equity interest in that property. That means you get all the benefits that go along with that, right? To your point, if the property appreciates, that your share effectively appreciates, right? If the property is going to pay out a distribution, you will be paid out a pro rata distribution, right? Lex is structured such that there's no way the GP, the guys who manage the property, can take money out unless they're paying all the Lex investors at the same time, right? So you're along for the ride. What exactly that property will do, I'm not allowed to officially predict, right? We're screening properties that we think will be good investments, and this has made it through our screening process. We feel comfortable putting it on the platform. We think it's a great asset and a great market. But there's no guarantee of a distribution. We do encourage our sponsors to distribute quarterly, and we try to really try to push that. But there is no requirement for them to, right? And it's actually to everyone's benefit, because if they choose to retain earnings, that retained cash, it's just more equity you have in the property, right? It's cash set in a bank account that you technically own a part of a right to, right? And that cash can then be used for other purposes, right? So if a tenant blows out and they need to give, they need to make an improvement to the property, maintenance needs to get done, they need to go and refinance the loan and pay a fee, right? Having that cash on hand helps them add to the value of the property. And when you buy into a share of Lex, you're a passive investor. It's something.
So, Alex, are you guys paid
He just got bumped
through?
I'm getting him back up here. Sorry, he I don't know what happened. He got knocked out of the space for a second. But if you have a question, maybe I don't know, John, you seem to know the business model pretty well at this point.
Yeah, I know the model. What's your question? See if I can answer your Lex question.
It's unfortunately it's Lex specific, so I don't think you would know unless you know their inner workings. I can ask you.
Shoot, I might.
How are they getting comp? Just underwriting fees, or are they getting some sort of carry on deals that they're conducting?
Hey, sorry guys, I'm back. I got disconnected there. So Lex makes money in 2 ways, right? We get an underwriting fee that's paid by the guys who are raising the money up front for the act of raising the money, right? They're paying us that fee up front, and that's the majority of the revenue. We also charge a small fee that's ongoing that comes out of distributions to investors, and that pays for the ongoing regulatory costs of keeping the public entity going, right? So every year there has to be an audit. There are regulatory filings. There's all sorts of work that has to be done in the back end to keep the quote unquote stock alive. And so those ongoing costs are paid out of distributions. There's never a case where you need to go write a check to Lex, right? If a distribution doesn't get made, that charge just accrues. And the next time one does get made, it'll come out of that charge. It's never going to be the case that, we're telling you, hey, no distribution got made, but we got to go pay for the auditor. Come write us a check. That is explicitly not what we're going to go do.
So what would that be like? Something almost like traditional asset management fee on a smaller scale?
Basically, yeah. And again, it's paid out of distributions, right? So if there's a gross distribution, your net distribution is a little bit lower, but it doesn't come out of your equity basis in the asset.
What is that approximately?
It's about 1% per year, so a quarter of a percent every quarter.
Okay, thank you.
Yep.
Okay, perfect. So we're right at an hour here. I gotta get some dinner in me because I gotta be on the move soon. So I want to go around, just give everybody a moment if there's anything else that they want to share. I really appreciate everybody that came in on these spaces. Hawk, big shout out, carried a lot of our conversation for the last couple of hours. Abbas, as always, a gem to have on spaces. If anyone's not checking out Abbas, the NFT millionaire, go ahead and click in. He's huge on these spaces. He so is in a lot of others. Chad, Deal McCore, extraordinaire. I appreciate you making the time. And honestly, I sent you the link and you were in here in like 30 seconds. So that was kind of wild. And then, of course, John, huge asset to have on these spaces every single week. If anyone hasn't checked out Balcony DAO, they are killing it. Over 1,000 deeds sold. Honestly, just a great, great space today. Okay, Abbas, any final comments you want to share?
Thank you so much for this space. It's so informative and amazing. Jumping from Web3 real estate to the real estate in real life, it's really interlinked. And thank you all, Lex, John, and Gav, for this amazing 2 hours.
Absolutely. Yeah, I really appreciate it too. I got a lot of education and such nice to have such a free education. I honestly feel like, the spaces that we've done just the last couple of months of real estate spaces, I never took any real estate classes in college, but this feels like a little bit of the on-ramp course that I would have gotten. Hawk, great having you on today. Glad to hear that you're really adept in the real estate space as well. Anything else you want to share today?
No, man. I want to thank, obviously, John for one, tolerating me, and two, for being here. And same goes for Lex. And thanks for hosting this, man.
Yeah, absolute pleasure. If you're interested in real estate ones, I can let you know when the next one is.
Yeah.
Cool. Chad?
Nothing much. I think this is great. Lex is great. Go check out their platform. Obviously, follow Wolf and Lex, and have a great day.
Appreciate it, Chad. Yeah, one more time for anybody who hasn't, I've seen several have already done so, and dozens of you have been clicking it throughout the space. There is a link pinned up top to claim your first $50 of real estate. Just a reminder, you can go ahead and make an account on Lex in just about a minute to go ahead and claim that $50 towards your first year of real estate. Really great deal. You don't see a lot of companies still giving out, kind of like $50 sign-up deals all around, but they do. And they've also done other benefits and bonuses. Like last month, they did a day where if you donated if you deposited 5K, you got like an extra 250 in your account. Like they really do incentivize, which is nice. And there's more deals coming out consistently on their platform. So really, really neat thing. If you just want to understand like what due diligence should look like into real estate, take a look at the platform. It kind of does a great job summarizing it. John, anything else you'd like to say on these?
Thank you, Gav, for having me up here. I love talking about real estate. I really do like talking about Lex. I like what they're doing quite a bit. Hawk, absolutely no bad blood. I think that the best spaces and the best conversations are where people are healthy cynics and they bring up these questions and interrogate the business model. So you're doing a service to the people on the space, and I appreciate you for it. And I look forward to being back here with you guys next week.
Absolutely. Looking forward to our one next week. We do these spaces with Lex and with back to back. So maybe we'll pop them that way next week. And Alex, I will throw it to you to cap us off here.
Yeah, Gov, thank you for having me on. It's been a pleasure as always. John, you got a shout out earlier. Much deserved for being a badass. You are a badass. Always love being on with you. Sad I missed the earlier space. Apologize for that. And totally separately, Tazonda, I'm actually a little bit like starstruck you're on the space. Super cool. I got to go talk to you this evening. Gov, thank you for putting together a great space as always with a great audience.
Always a pleasure, Alex. Yeah, I love to see who comes in here. My favorite like lurkers have been like Michael Dell comes and lurks. MySpace Tom used to lurk at my spaces. So there's definitely some fun ones. So we appreciate everybody that's in here. Of course, we see the check marks up at the top, but everybody else that's in the audience, we really do appreciate you taking the time. If you like Twitter Spaces, make sure you're following the Wolf account. You can also check out my personal. It's a Goff Blacksburg account. I will be live potentially tomorrow around like 3:30, and then next week I'll be back on with a full slate, 40 hours of content. I'm ready to be back at it. I was traveling this week with NFT NYC, but ready to get back into the thick of it. Already been DMing a ton of people today, planning 25 plus spaces for next week. So you'll really get your full fill. Shout out Lex one more time. I see like several more people just made accounts. Like I'm getting emails as we're doing this. So if you haven't already, links in my bio in case you don't see it in the space anymore. Take care, everybody. Enjoy the rest of your evening. Happy Thursday. We're almost there. Friday, baby. Take care, everybody.